Hello, one and all present here. This is Amit Kumar Singh. Welcome to the one more session. In this session, what I'm going to teach you, I'm going to talk about capital structure model. In this, we'll discuss the different theories under the capital structure theory. Under this capital structure model, what we basically talk about, we basically talk about the relation between. We'll basically discuss the relation between the capital structure and the value of the firm. So the objective of understanding this chapter is to find out the relation between capital structure and the value of the firm. Is this really important term? So whenever we talk about valuation of the firm we can do through discounted cash flow method or free cash flow to equity or free cash flow to firm or capital cost of flow method. So a lot of methods are there to discuss the valuation of the firm. But the concern what is there in the mind of me, in the mind of different mathematician and financials from the long time was to really understand the relation between the capital structure and the value of the firm. They were really wanted to understand is really the capital structure creates any value for the firm, or is it just an hypothetical framework. So basically, when we discuss this relation, the first two models what I'm going to discuss here, I'm going to talk about. Sorry. So first, I'm going to talk about net income approach model, and then I'm going to talk about traditional approach model. Both these models talks about that yes, the capital structure of the firm will affect the value of the firm. So according to both these model, the bringing of debt in the capital structure will fluctuate the value of the firm. How they fluctuates and all. So that is another point to discuss. Fine. So basically, when we talk about net income approach model, so under the net income approach model, I'll just show you the form of graph. So under the net income approach model, imagine there's a firm which is having 0% debt in the capital structure. Such kind of firm is called as unlevered firm, which have 0% debt in the capital structure. That is called as unlevered firm. And the firm which have debt in the capital structure, when they start having debt in the capital structure, those kind of firms are called as levered firm. So fine. So when we talk about net income approach model, so what net income approach model says, that net income approach model says that the value of the when you talk about net income approach model, it says that the cost of equity is always more than the cost of debt. So we know this cost of equity we can determine through CAPM model, or we can determine from Gordon or Walter model. So we believe that always the cost of equity is more than the cost of debt. And under the net income approach model, we believe that the cost of equity is more than cost of debt, and both are constant. Cost of equity and cost of debt both are constant. And when we bring more debt in the capital structure, then automatically the WACC of the firm will go down, and the firm will have the maximum value if the firm is 100% debt finance. This is what this model talked about. The model called net income approach model, it basically talks about the more debt you bring in the capital structure, better the value what you bring for the firm. And you know that, I believe everyone knows this, that the value of the firm is basically inversely proportional to their WACC. Why this? Everyone knows this. Fine, because we basically use a discounted cash flow method, where the WACC we take as a denominator to determine the value of the firm. Fine. So when we talk about net income approach model basically works in this concept. While when we talk about uh, when we talk about this traditional approach model talks about the scenario where it believes that the cost of debt is more than the cost of debt is less than the cost of equity. Always the cost of equity is more than the cost of debt, but cost of equity and cost of debt are not constant. So more debt whenever you bring in the capital structure, when you bring more debt in the capital structure, the debt is cheaper than the equity. So that the advantage what you get from the cheaper debt over the equity, that advantage will dominate over the disadvantage what you get uh, by bringing debt in the capital structure, because debt brings the financial distress. So whenever you bring debt into capital structure, it brings both advantages and disadvantages. So the disadvantage of debt in the capital structure is that it brings the solvency, it affects the solvency of the firm, it bring financial distress, it bring the situation where it creates a probability of the default for the firm. Because in the case of debt, the payment of interest is a compulsion, either you get a profit or loss. So when you bring debt into the capital structure, you are actually increasing the risk of the firm, that is called as financial risk. So when you bring debt into capital structure, that when the financial risk will increase, then normally definitely the investor will expect a more return, because the risk is increasing. So they will expect a more return over the capital structure. And when they expect more return over the capital structure, so normally you have to pay them more. So automatically the risk will increase. But initially when you bring debt into the capital structure, so the disadvantage of bringing the debt, that factor would be lesser than the advantage what the debt brings you, because the cost of debt is cheaper than the cost of equity. So initially the WACC will decrease till certain extent, and then it will increase over the period of time. So this is what the traditional approach model talks about. So the traditional approach model talks about an optimality, a situation where you have the best case of where you have the best case of your what you say, where you have the best case of your WACC. So that situation it is basically talking about. So this way, this can be called as optimal, this can be the called as optimal WACC. So if in this case, when you talk about when you talk about this case, in this case when you look into the value of the firm, so when you talk about in the traditional approach model, the value of the firm, so the value of the firm first increase and then it will decrease. So like as you know that the value of the firm is inversely proportional to the WACC. So this is a traditional approach model. So in the case of traditional approach model, we believe that the cost of equity and cost of debt are the cost of equity and cost of debt are not constant, although the cost of equity is more than the cost of debt. But when you start bringing leverage into the firm which is 100% equity financed is called as unlevered firm, and when you bring debt into the capital structure, it become a levered firm. So the more debt you bring to the capital structure, the more the firm will become levered, more the financial risk on the firm will increase, and more the risk will increase, so more the return the equity investor will expect, because they are the owner of the company. Creditors are not the owner of the company. More the return they expect, definitely the risk will increase. And initially according to the traditional approach model, initially the value of the firm will increase, because the initially the WACC of the firm will decrease, uh, because the disadvantage of bringing the debt, that would be that would be lesser than the advantage of bringing debt, because debt is cheaper than equity. But in the case of net income approach model, we believe that the both debt and equity are constant, and always the cost of equity is more than the cost of debt. So more debt you bring to the firm, the better would be the value of the firm. So these two models I plan to discuss in these two class. I believe you have understood whatever I've discussed. One more session I'll take on the value of the on this two model, where I'll discuss little bit of mathematical part of it. Okay guys, thank